Okay, so now we are going to move on to question 2. Now, question 2, let's quickly see what was the you are required to. Okay, so if we scroll down and we start with what were you required to do based on the question. So you see there's a two-part to this question. So the first part of the question, they ask you to calculate the tax liability for Viral Quip Pty Limited for the year ended 31st of September. So that means our year is running from 1 October 2019 up to 30 September 2020. Now I like to write the year ends generally just in the question to help me see whether it's a prepayment or whether it is something that relates to a prior tax period so that I don't necessarily include it. Okay, so that's even before we start the question. I just like to write it down so that I know exactly what type of information would be relevant or not. Now, what is important here is they tell you to start your calculation with sales gross income. So they want you to use the tax framework when answering your question. They tell you to show all your workings. Now, the reason you need to show the workings is if you make mistakes, we can allocate marks for your calculations. I'm just going to write your calcs if you make a mistake. If you don't do the calculation, but you get the amount right, I will still allocate all the marks to you. In the case that you get it wrong, you get a 0. So that's why we ask for the workings. Now you can do the workings in one of two manners. You can either include it in brackets next to the item as you calculate it, or if you prefer, you can do working separately at the bottom of the question, and then I will go mark it there. Another piece of information that was important to see here was the write-off period for your vehicles was 4 years. So that is for your wear and tear allowance that you need to do. So in this question, you'll see they've included wear and tear as, and in the prior year's question, which I'm busy working out for you guys as well, they've also included your capital allowances. Now for this test that you guys are writing, it's only up to Learning Unit 5. So this would not necessarily be included in your question. What they can, however, ask you is they can give you the amount and then you just need to go include it. For example, your capital gains or your taxable portion of your capital gains, they can give you the value and you just include it based on the format, but they won't require you to do the calculation as yet. Okay, so that's the first part, working out the tax liability. Then part 2, so as we read the information, we're going to look at how to do the tax liability. Part 2, they're asking you that the two shareholders are very concerned about the amount of taxes they are paying to SARS, and they feel they need as much of a surplus cash as possible in order for to further their research. So they want you to write a memo and suggest ways in which they can reduce their tax liability. So as we go through the information, I want you to think about what they're saying and how can we potentially reduce the tax liability in terms of this question. Okay, so let's scroll up to the beginning of the question. So they tell you Viral Quip Proprietary Limited is a company that is founded by two biomedical science students, Kathy and Leanne, who specialized in the study of virus behavior. They formulated an antiviral spray that could be diluted in water and used to sanitize surfaces or as an aerosol to sanitize the air. Just want to make sure I am recording this. Yes. Then they tell you, due to the spread of the COVID-19 virus globally and the need for antiviral solutions, the company started receiving an increased number of orders from overseas countries and expanded its operations to New Zealand and Canada. And their financial year end is 30 September 2020. As CAFE owns shares in various other companies, they do not qualify as a small business corporation. Okay, so based on that information, we know this company, when we work out the tax liability, is seen as a normal company for tax purposes. So if it's a normal company, our tax rate is 28%. But I also want you to put this in the back of the mind, potentially for question 2.2, where they ask you how can they reduce their tax liability or the taxes they pay. We could potentially write something regarding the small business corporation in answering that question. So if you see something like this and they've asked you how can they reduce it, this could potentially be one of the answers. So let's read what else they've written. Then they tell you the following information relates to viral quip activities for the current financial year. All amounts exclude VAT unless otherwise stated. So this means our company is VAT registered if it excludes VAT. Now remember, if they give you amounts inclusive of VAT and they tell you the company is VAT registered, when you do the income tax calculation, you have to remove the VAT component. What does that mean for you? For your test, because Learning Unit 2 is still part of it, you need to know what is standard rated supplies, which is split between your 15%, which is standard rated, and your zero rated supplies, which is 0%. And then you've got the exempt component. Now, the reason I'm telling you this is as we go through the information, you'll see some of the amounts are, for example, inclusive of VAT. Now, if you don't know what the different rates for VAT is for specific components, you will not be able to do the calculation in the question, or you will lose those additional marks. Okay, so let's run through the additional information. They tell you revenue received from South African customers amounted to 7,853,000, and that is inclusive of VAT. Now, when you read South African customers, you need to think standard rated VAT, and that is 15%. Okay, so that is within South African borders. Now, if they already tell you it's South African, and in the top we've read that they've expanded their operations to New Zealand and Canada, you need to also expect that there will be export sales. So then they tell you revenue from customers in New Zealand and Canada was 1.25 million, including VAT. Now remember, export sales is zero rated. So that means 0% VAT. Now, if you did not know the difference between the different VATs, you would have applied 15% to that component and you would have actually lost the mark. Okay, so you see why the VAT learning unit is also important for your test on Monday. They can ask it like this, or they can ask you the VAT or income tax treatment for a specific transaction. Okay, so they said start off your question with this. So first going to read through all the information and then we're going to do the calculation just so that I don't have to flip between all the documents online. So I want you to make notes now, and then when we get to the Excel, then you can just read your notes on your piece of paper, or if you're online, just on your document that you've opened. The next item, they tell you investment income received was in the form of dividends from various listed South African companies, totaled 68,000. Okay, now remember, dividends are included in your gross income. And they are also an exempt. So what this means is you include that amount in your gross income line item, but you also include it in your exempt item. You actually get a mark for both of it. Do not leave it out, then you lose 2 marks for something that is not very difficult. Okay, so you need to show it in 2 places. So remember, I can only include something under exempt income or exemption if I have previously shown it under the gross income area. Then they tell you we've purchased antiviral spray for the year amounted to 2.8 million. And then they give you the stock on hand, the market value, and the cost. Now, why are they giving you this information? Now, remember, when we generally do the tax calculation, we are using our set of financial statements to populate these amounts. Now, in accordance with our accounting treatment, we show our stock at the lower of cost and the net realizable value, which is the market value. Now, for tax purposes, you will do the deductions the same. So if the market value is lower than the cost, you will only be allowed to deduct the market value in that calculation. Okay, so indirectly, the amounts would have already been deducted when you had the purchases at cost, but if they are left over, those additional write-offs are taken into account in this calculation. So what that means is when we do this calculation, we need to go look at the market value versus the cost, and the lower of the two will be included in our calculation. So if we look at this, for 2019, the opening balance, we will use the market value because it is the lower of the cost and the market value. Whereas for 2020, so our closing stock, we will use the cost because that is less than what the market value is. So now we are testing if you know the difference between the two by giving you a table like this. Okay, so if you see a table like this, this is the reason for it. They want to see if you know which of the amount should be included. Then we go on with the information. They tell you we donated antiviral spray with a cost of 22,000 and a market value of 28,500 to be used for getting schools ready to resume the school calendar in light of COVID-19. They tell you no formal documentation was received. Okay, and they are registered PBO. Okay, so the first thing you had to see, we are donating something to a PBO. So there is the recoupment that needs to happen for the stock that was given away. But now the question is, at what value will we actually include it? Are we going to include it at cost or at market value? So I'm going to say your cost or market value, and we put a question mark next to it. So we need to go decide which of these two values will be the recoupment. Now the other thing which I said is if you make a donation to a PBO, you are allowed a Section 18A deduction, but only if you have the documentation. Now in this scenario, they told you we have no formal documentation. So that means SARS will not allow this deduction, even though you've made a donation to the PBO. In a test, however, they could give you a similar scenario like this and tell you they've received the Section 18A certificate, and then you would be able to claim the deduction right at the end as well. Okay, so this is just why I want to highlight this information, because they could potentially ask it the opposite direction. Okay, so let's go on with point 4. In light of the pandemic, many others started capitalizing on the sales of various antiviral products. One such company claimed to be a division of ViralQuip and started marketing their products under their brand. ViralQuip immediately decided to register a trademark. So we registered a trademark for the brand and patent the formula. The trademark and patent therefore were purchased for $27,000 and $38,300 respectively. Okay, and then the registration cost for the purchases amounted to $37 and can be split equally between the trademark and the patent. Okay, so this is where we have to think about these two sections. One where you acquire, it is generally a patent, a copyright, and a design, or a renewal. So you have to go look at the two sections. So let's quickly look in your textbook. I'll tell you what page it is. Just find it for us. I want you to just make a comment there while we're busy with it. Okay, so 4.6.1 on page 241. So make sure that you know this one because they will ask it as well. I've seen in the prior year before this, they've asked it as well. So what you will see, they've got one section that talks about the acquisition or the capital expenditure on patents, designs, trademarks, and copyrights. Okay. And then they've got the acquisition and the extension on the renewal. Now, if we look at the acquisition, they talk about patents, designs, copyrights, another property which is similar of nature other than trademark. So for the acquisition, it refers to any type of intellectual property except for the trademark. So in this question, you can see that they've acquired a trademark and a patent. Now what that means, you will have to go split it between the trademark and the patent amount. So the trademark one will have no deduction in terms of section 11 BC. Okay, whereas with the patent, we will get a deduction, but now we have to go look at what is the value. So this is where the 5,000 or more or less is. Now, because it is more than 5,000, we are allowed to use the 5% of the costs as a deduction. Okay, so whatever it costs them to make the deduction, that is what we will be able to deduct. So for this question, you had to see that there's a trademark and a patent. The one will be deducted in terms of this deductible in terms of the section, the other one won't be. Okay, then we move on to point 5. Then they tell you Kathy and Leanne is constantly conducting scientific and technical research on how to evolve their product and develop new products. The research costs amounted to $68,500. However, their research has not been formally documented or sent for approval. Okay, now your deduction in terms of section 11D will be 150%, but only if it is approved and conducted in South Africa. Now, because it is not approved, this would be limited to the 100%. Now, if they do get this approval, this portion could also be part of question 2.2 on how to reduce my tax liability or the taxes I am paying. So that is what you had to see from this paragraph specifically. Then if we move on to point 6, they tell you that the company has been operating from a vacant building adjacent to the laboratories at the University of Cape Town. This was due to convenience, and the rental of $15,000 per month was payable to the university. However, due to expansion of operations in March, the company purchased a plot of land. So we purchased a plot of land for $65,000 and erected its own office building on land, and that costed $1.2 million. Okay. There are a few things you had to see. So the first one was the rental expense. Which they've incurred. Then you had your purchase of land and property. However, these are capital in nature. So that means they will not be included as a deduction because of the type of expense it is. Then they tell you the building was completed on the 1st of August and the company moved its operations to the building immediately. So that means from 1 August, we can get a capital allowance for the building. Because we are starting to use it then. Okay? And then rates paid to the year. Let me just move that there. Rates was paid for the year amounted to $8,900, including VAT. So this is where you need to know that rates and taxes are an exempt supply. So it will not actually have VAT included in that amount, so the full amount will be deductible. Okay, so you can see how they're bringing in the VAT components in here. Okay, then point number 7, we've got legal fees that was paid to draw up a contract for the land purchased of $7,600. Now, because of the fact that these legal fees are spent on a capital asset, they will be seen capital in nature because they create an enduring benefit. Okay, so these legal expenses will therefore not be deductible, but you can include them into the base cost when we get to capital gains for your property to reduce the capital gains you would eventually have. Then point 8, the company also decided to start delivering their products to customers and therefore purchased a delivery vehicle on 1 September 2020 for $280,000, including VAT. Okay, the following costs were incurred in respect of the delivery vehicle. Okay, so we've got insurance, inclusive of VAT. They paid it upfront from 1 September 2020 to 31st of March. Now, if we go look at when our year end is, 1 month is in our year of assessment, and the remaining 11 months is a prepaid expense. Okay, so that means we need to look at section 23H to see how to deal with that. Then we've got fuel inclusive of VAT. Now remember, fuel, I'm just going to move this one there so I can just add another comment here. Remember, fuel is zero rated. So that means VAT is 0%. Then we've got repairs. We've got speeding fines. Now that is a prohibited deduction in terms of section 23. Okay, What I did not write with the delivery vehicle, remember delivery vehicles is input that can be claimed. Okay, so that means when we work out the wear and tear deduction, we have to remove the VAT from that amount. Okay, we are almost done. I'm just going to read the last 2 points and then we're going to take a 10-minute break and then continue, okay? Okay, so then point number 9, they talk about staff costs and then they break it down based on what the deductions are. So the first one is salaries and wages, which is our normal salaries and wages expense, which we can deduct as per normal. Leave pay, we need to go look at whether there's any provision for future liabilities, because that is prohibited in terms of Section 23. So what they tell you is leave pay included in this amount is $8,000 in respect of the increase of provisions for leave pay. Okay, so what that means is the provision part is denied in terms of Section 23, so you cannot deduct it, and the remainder was paid in cash. Now, because the remainder was paid in cash, the remainder can be deducted because it's an actual expense. Okay, so that's why they've given you this information. So there's 2 components to that item. Then we've got annuities paid, which can be deducted. We know any contribution the company pays to medical aid, to provident fund, pension fund can be paid, deducted. Then we talk about dividends paid. Now, dividends paid is capital in nature. We do not actually get a deduction for it. So you do not get the deduction, and it will then also be taxed in their individual hands. And then restraint of trade payment, we have to look at the longer of 3 years or contract period when we work out the deduction. So let's see what they say in the next paragraph. They tell you that the restraint of trade payment was for a former employee to stop trading for the next 2 years. So that means we use 3 years when we do the calculation. Then the doubtful debts amount, list of doubtful debts for 2020 was 303,000, and the allowance claimed in 2019 year of assessment was 90,400. Now remember, we add back the prior year amount and then we calculate the current year. So the current year you would have calculated using 25% based on the information. And then they tell you bad debts actually incurred consisted of 60,000, and of this 2,000 was in respect of a loan to an employee. Okay, and the company adopted IFRS 9 for financial reporting period. Okay, so the bad debts, the 2,000 Rand that was to your employee, the loan. You have to exclude this when you do the deduction, as it was not previously included in your gross income because it was capital in nature. So then what happens is you're not allowed to get the deduction when you write it off as bad debts. Okay, so because they said the company adopted IFRS 9, In the scenario, you will still use 25%. The new percentages only became effective from 1 January 2021. And then it would be the 40% for anything over 120 days. Between 60 and 120 would be 25%. And if they tell you it's in terms of IFRS, you've got 25% if it is for impairment, which is what a provision is. If it is for any credit losses, allowances, but they need to specifically state that, then it would be 40%. Okay, so this is just all the information. Let's take a 10-minute break. If you guys can be back 10 past, then we will continue with now doing the physical question based on the information discussed.